My name is Don Hart, Vice President of Training and Development. We've got a great presentation for you today. I've previewed the presentation, and I know that you're all going to enjoy this, and you're going to particularly enjoy our speaker. He's an advisor, or was an advisor, like all of you, obviously. But Brent Swatuk is the Advanced Case Consultant with Equitable Life of Canada. For the past 23 years, Brent has been making an impact helping advisors increase their knowledge of insurance products, the art of questioning clients, solving problems, and on how to present those solutions more effectively. Brent started his career in sales with one of Canada's largest insurance carriers, and later he was a national marketing director, advanced case specialist with one of Canada's largest managing MGAs. In the past 15 years, Brent has spent with two great Canadian insurers. And he's at the best one right now, right, Brent? And as an advanced case consultant focusing on helping top advisors create solutions for their estate and corporate cases. He's also earned his CHS, CLU, CPCA, EPC designations. The chat line is open and the Q&A is open. We are recording the session, but I'd like you all to welcome Brent Swatuk. Take it away, Brent.
All right, perfect. So let's dive on in. This is, and I'll credit Don for a lot of this presentation. I've been friends with Don now for about 15 years, and he has been a solid friend and mentor to me, and we've always been able to bounce ideas off of one another. And one of them was this idea for, he calls it flatten the tax. Apparently our legal and compliance officers have a problem with the word flatten, so we called it levelize the tax. So whatever. You know, the basis of the concept works really, really well. I have another version of this, which I call bolstering the corporate balance sheet. But then after I called it that, somebody else came out with the same sort of title. So we're just going to call this one levelizing the tax for corporations. So why don't we dive on in? Obviously, standard disclaimer, we've done our best to make sure we're using current up-to-date software, that, you know, any taxes and stuff that we're mentioning, we're upfront about, and that we're being as transparent as possible as we walk through this. And so for today's agenda, there's actually one piece missing on the end. I threw an extra little piece in here. And that is that, so first we're going to go through an explanation, a brief overview of Equitable Life. So if this is your first time engaging with us, interacting with us, first, welcome and thank you. But if it's not, then welcome back. And I'm just going to tell you a little bit of the highlights, some things that I really appreciate about Equitable Life, and things that I have found, as Don mentioned, my main client is corporate clients and high net worth individuals. So I'll tell you what the insights as to what they've liked about our company, and it's a very brief overview. I'm going to talk about our Wealth Accumulator redesign. So we redesigned this product. It's got to be going on about 2.5 years now. I sat on that team that helped redesign that. We had a great product before, but it wasn't the most flexible product before. We didn't have as much overfunding room in that product as what was desired out there and what was being sold and what clients were looking for. And so we redesigned that. I'm going to show you quickly what that looks like and why that's extremely balance sheet friendly, and why listen, other companies have now copied the way our cash value patterning goes. So it's flattery when they copy you. And, you know, we think we hit it out of the park on this one. And obviously our competitors agree with that, because we had two competitors redesign their products to basically match what we're doing. So that's great. And then we're going to get into the main meat of the concept, right? The levelize the tax for corporate clients. As I said, this was a concept that was taught to me by Don, but I'm so thankful that he taught it to me, because honestly, I have this conversation many, many times and over a month, or, you know, it's a couple times every week. And the last piece on here that I added in, a little bonus piece called portfolio enhancement strategy. And it fits really nicely with this idea, only as opposed to just skimming the milk off the top and moving that into permanent life insurance, we're going to look at it from a different angle. So, you know, a couple really great things that I hope you get some takeaways. You know, it's that old saying, if you only get one takeaway, I feel like if I only give you one takeaway today, then I probably failed at what I did. So hopefully you get a lot more than one. So Equitable Life, founded in 1920. So for those of you that are doing the math, yes, we're 121, or sorry, we are 101 years old this year. One of the beautiful things about our company is we are a mutual company. Most of the companies out there, my previous company, are stock companies. If we put the ranking order of who matters most, shareholders always come before policyholders, but not with a mutual company. So we do everything for our number one stakeholder, which is our participating policyholders. And we've been offering par whole life since 1936. So we've been doing it a while, not as long as some, obviously, because we're not as old as some companies, but we have been doing it since 1936. And us, as many carriers will boast, have paid a dividend every year since 1937, right? Because obviously you pay them at anniversary. So if we offered it in 1936, we've been paying since 1937. So nice long track record of paying dividends. But really, at the end of the day, so we're not the biggest par fund out there. We call this the Goldilocks effect, right? So we're not too big, we're not too small. We think we're just right. And we think we're just right because 23 out of the last 25 plus years, we've pretty much had the top yield on the market, which is great. In the last decade, I just saw a recent competitor's presentation. In the last decade, we have been the top yield 5 out of those 10 years, and we were the second place yield. And yield long-term, folks, is important to your par fund, obviously. So you don't have to be the biggest par fund out there. You just have to be able to get yield in order to have great results for your clients, considering that, you know, for most carriers, mortality and expenses are pretty equal and relative. Keep pushing the wrong buttons. So we did get bond rated a couple of years ago. So we had this thing. So before companies, the regulator used to require us to do this reporting under what we called minimum continuing capital surplus reserve. And it's how much dollars you have over what the regulator requires you to have. It's a certain amount of financial stability they require you to have. And that changed. It went to a new accounting format called LICAT. And I'll get to that in 1 second. We are a well-capitalized company, but during that time, there was this instability, or there was this kind of worry by every company saying, figure out under this new accounting measure. Equitable thought, hey, maybe we should go out and get bond rated. Up until this point, there wasn't really a big need to get bond rated. We don't issue bonds. We're not, you know, we're not a stock company. So we're not trying to raise capital that way. We've grown organically up until that point. We're mutual, owned by our policyholders, and we're heavily capital. We're backed heavily with capital, right? So everything lined up really good. We never really had the need to go out and get rated, but in this year we decided to do it. We were rated an A. We've been upgraded ever since then. You know, so A. There's all these like individual ratings in between. So right now we're an A high with stable trends, and that's a really great place for our company to be. And when we think about LICAT, you know, from a financial strength position, this is fourth quarter of last year. These just came out. Everybody's kind of slightly lower than what these numbers are now. But if you take a look, for every dollar that the regulator requires us to have, we have $1.66. So that puts us in a very strong position in relation to the other fine companies that are out there. Not that, by the way, these are all great positions for every one of these companies. I'm just saying that there's a lot of times where people feel Equitable is not the size of some of the other companies. Well, remember, we're heavily asset backed. We're highly rated by a rating company, and we do everything for the benefit of our par policyholders. So that gives us a really unique position in the marketplace. And one of the cool things about this LICAT is, I mentioned it, we're not raising bonds and pulling that into our balance sheet or into our holding companies to increase these numbers. This is just purely off good business acumen. This is purely off of good organic growth. So it speaks, this started way before Brent Swatuk joined the company, but you know, it does speak to just a really good reason why people would want to consider Equitable Life. All of this is summarized in a book, in this brochure that we call the Advanced Markets Brochure. It's a beautiful, thicker stock paper if you ever want one of these, or if you're ever going out to see a client again. But this can be found on Equinet, or you can reach out to your regional sales manager and they can get you a copy of this. This is soon to be updated, but it will have all these metrics in there. So if you want to put this in front of a client that's never heard of us, because we're not on Raptors jerseys and hockey boards and that sort of stuff, but we have a really good, solid financial story to tell people, and we have really good product, then I would suggest this is a great piece for you to start with. So that's enough about the overview of the company. Let's talk about quickly about the product redesign. So I'll tell you what we did, and then from there, and I'll tell you why it's good on a balance sheet. And then from there, we'll get into how do you actually have a conversation about all this with a client, with the right client. And so we, like most companies, we reverse engineered a product that came into the market back in 2008 from one of our competitors. So we've got an estate product and a wealth product, pretty much like every company out there. And if we were, and when do you use one product over the others? Well, this estate builder from a cash perspective starts out really low and then gets really high. And it's great long term, and it's great for those IRP concepts. And I think that people that buy these are typically like doctors, dentists, sometimes lawyers, where they're fine not seeing cash on their balance sheet for a while, and they really want to see the longest maximum return on that. But if you're dealing with a manufacturer, car dealer, accountant, sometimes engineers, real estate professional, second mortgage individual, where they don't like to see a big drop from moving from cash to cash value, then I would say that this Redline product, this wealth accumulator product is really the product that they're going to be most comfortable with, more focused on, right? And I would say that probably 95% of all the cases I get involved with is going to be this product because of the way it is designed. And so we did this redesign really for a number of things. So as I mentioned, we had a good product. It was a good, solid product. It paid well. It had high early values, but we wanted to make it better than what it was before. And so part of that was we had a lot of call in the marketplace to make the product more flexible through adding more deposit room. And so we had to play with how the product was shaped, but yes, we were able to achieve that. What that meant was really there was a bit of a trail down in cash value over the first 2 years, but a lot of times in year 3 forward, that product actually performed better. And I'm going to show you an example of that in a second, than what it did on the old product. So it had an earlier break even because of the high early cash surrender values. And the one thing that I've learned in dealing with, very wealthy individuals is they're willing to buy into the long term, but a lot of times they want to see, when do I go from the red to the black? Like, when do I break even? And if I wanted to call it quits on this thing, I could walk away from it and I'm not getting hurt. That's what this product is really designed to do. It's designed to break even very early, and it does a great job on that. The other thing we noticed was we were getting a lot of, so we're just as competitive on our 20 pay as we always were, but the market was shifting back towards life pay, which was interesting. I think a lot of it was due to the fact that there was an increase in immediate finance deals out there, or interest in immediate finance arrangement deals. And so the life pay tends to work better with that. There's also a lot of folks that wanted really quick duration pay, and life pay tends to get to a lower pay period, even -2, right? So that was a lot of the call that we were hearing. And the other thing too was we had brought on, folks like Brian McNulty and Marvin Toy, who were 2 tax lawyers. We had brought on this advanced case team to go after this market, and we weren't really priced well after age 55. So, you can't really want to play in high net worth individuals, but cut off at 55, right? So what we did was we made it more competitive for us to deal with folks in the older ages, because, you might have a business owner that's 60, 63, and they like our product and they like our story, but if we price ourselves out of the market, that we're basically shooting ourselves in the foot. So we did a great job on redesigning this product. And I'm going to give you an example on why I say it's very balance sheet friendly. And so let's just take a look, right? So over here, we've got a male 45. And don't get me wrong, I'm not saying that we'd figure out their insurance needs just based off what they can deposit. Typically, we're figuring out what it is that we need to solve for. But in this particular case, I'm just saying if we had an individual and they were looking to maybe convert some of their term and they had 100K to deposit on an annual basis, then we might be looking at wealth, and it would look something like this, which is 100,000 deposit. The first year I'm below water about 33K. From a death benefit perspective, so if I punch the wrong ticket and I pass away this year, that $100,000 deposit has a couple 1,000% return. and will result in my corporation getting $1.8 million, of which most of that's going to flow out through the capital dividend account. So it's a really cool setup, and I'm not seeing a massive drop from cash off my balance sheet into cash value, right? In year 2, you'll notice that I go from 100 to 172. And in year 3, something special happens. And one of my early mentors when I worked at the last company was a guy named Dennis Capone Sr. And Dennis said to me, you always want to look and see how deep the water is. And in this product that we've built, the water is actually 3 feet deep. And what I mean by that is, in that year, when I transfer $100,000 into this policy, well, my cash value is going up by 100,000 or greater. And every year there forward, you'll see that that cash value, every time I make a move from cash to cash value, I'm getting $100,000 worth of growth over that period of time. So the water is 3 feet deep in this product. And the product goes from the red to the black, meaning that, I put in $500,000, it's worth greater than what I put in by year 5 in this particular setup. Sometimes it's year 6, depending on how old the individual is, or if they're smoker or non-smoker, right? Here I've got a 45-year-old male non-smoker. So I go from the red to the black in year 5. So what does this mean? For this individual, if they decide they want to pull out, they're getting back basically everything they put in year 5. There'll be some small tax to pay, but basically this is probably not the worst financial deal that they've ever put together in their life. Ultimately, remember, we're selling life insurance. We're selling options and values. So this cash value on their balance sheet, a lot of times that's what we're focusing on. And it's awesome. And it's great because of all the myriad of tax advantages. So as this is growing, it's growing tax deferred. If I pass away, this death benefit comes in, all tax paid up capital, right? So all tax free into the corp. And I'm going to get CDA inclusion, and that gets 100% CDA inclusion in this particular scenario in year 37. So from that point forward, if I pass away, when I pass away, that money has the ability to be untrapped or liberated from my corporation on a tax-free basis. Honestly, folks, I know this isn't a presentation about CDA, but it's this myriad of items that we put together: the tax deferral, the heavy cash value on the balance sheet, the ability to not use the liquidity or to not lose the liquidity, use, and control of that money, and the ability to have it pay out through the capital dividend account. That really makes what we do so special to business owners. And a lot of times you're going to get comments that say, this is probably too good to be true. And it's funny, somebody said that with their accountant on the line the other day on a meeting that I was on, which I never thought I'd be selling 6-figure premiums online. I never thought that was going to be feasible, but it is. And they said, I don't understand. Oh, sorry, something popped up there and caught my attention. They said, like, this has got to be too good to be true. And I said, well, it depends on where you're getting your financial education from. If you haven't realized that you've outgrown the Dave Ramsey, Susie Orman School of Education on finances, that you have structures and options, then you're right. This probably seems too good to be true. But if you're dealing with any tax professionals, there is a reason why the largest accounting houses in the country have been setting up family offices, folks. And family offices are really good at dealing with people and getting them to deal with the soft points of their money and their businesses and that. But they're also heavy promoters of permanent life insurance to make sure that families do not go shirt sleeves to shirt sleeves in 3 generations. So this is just awesome what we get to do. And if we understand how the products work and where they fit, we can have really cool conversations like as Don would say, flatten the tax, as we would say, levelize the tax on corporate fixed income. So I'm going to show you an example coming up. I don't want you to get freaked out on the numbers. I use big numbers, but I tend to get in front of big clients. The largest premium that I've been involved with in the last 6 months, which we closed and it's been placed, was just under $2.5 million in annual premium. So it's not to say that every case is that, but there are these cases out there. But understand that the idea is scalable, and we have software that'll actually help you scale this to your business owner, whether they have $100,000 in excess cash or they've got $100 million in excess cash. There is always a strategy for these folks. Anybody, so I like this presentation when I'm doing it live. It's a little hard when you can't see people's faces and that, or get hands raising in a crowd. But If I was doing this live, I would say, anybody got corporate clients that are paying too much in tax on their corporate fixed income? And I don't care where you reside in Canada, and it's worse the kind of the further east you go, because they pay a lot more in passive income tax. But, you know, I would expect to see everybody's hand in the air, right? Because we all know that, first off, business owners work hard at what they're doing. They take the risk in their business. And a lot of times they take a lot of that cash and they take a lot of that earnings and they put it into cash because they are taking that risk in their business. And so they're putting that money in cash. They're putting in cash alternatives, bonds, whatnot, T-bills, you call it whatever you want, but they're getting a very low rate of interest on their money. And then they're getting murdered in tax. And in Ontario, and I'll speak to Ontario because we pay 50.17 here. So if you're in above 50%, think about that. You make $1, you're shipping more away to CRA than what you get to keep. And you had to work hard to put that dollar in there in the first place. So, you know, it's important that we work to help people with these tax things. And that's what this concept's going to talk about. If they're like most business owners, they're certainly paying more tax than what they everybody has to pay their tax, folks. It is a social system run on tax revenue. Everybody's got to pay their tax. But remember, nobody said that you have to leave the CRA a big tip. And so there is 2 tax acts out there. There is the Tax Act for those that understand the Tax Act, and then there is the Tax Act for everybody else. And what we're going to show them is ways that they don't have to transfer away their wealth. You know, and and it's all legal, right? Like everything that we're talking about is just legal ways of structuring their wealth, so that way they don't have to transfer it away and paying tax unnecessarily. So if we meet with a client, they might have a portfolio. We put in the portfolio because you know, you might be dealing with somebody in a professional corp and they're running an entire portfolio in there. You might be dealing with somebody. I saw a case yesterday where it was all this part was real estate and all the rest of their money was sitting in cash. And I mean, they had more than $1 million sitting in cash on their balance sheet, earning nothing really, right? And worse, the worst is after the tax position. And when we talked with these folks, I said, how does the tax get paid? And fortunately, it fell into this scenario. And that scenario is that their accountant was taking just enough off the table every year to pay the taxes. There is an uglier scenario to this, folks, where your accountant isn't taking any money off to pay the taxes, but they're paying taxes out of your other earnings. And if that's the case, you don't have what's called a growing tax bill, but you have a compounding tax liability, and that's a different position to look at. But what we have here is we have an individual, they're earning some income or some interest on their fixed income, and their accountant's pulling just enough off the table every year for them to pay that tax. And what we've got to realize is a lot of those clients' wealth is being transferred away in tax. And if there was a way to recoup that tax legally and bring that back into their financial lives, right, their family's financial life, would that be something that they would want to talk to you about? Right? If you didn't have to transfer that money away in the form of tax and you could keep that, and that could help you build your wealth, accelerate your wealth faster, would that be something for us to have a conversation on? The answer almost always is yes. Nobody wants to pay more tax than what they need to. So let's take a look at an example. And here what we have is we have a male 50 is a large sum of investment. Like I said, don't get scared off. This works whether they have 300 grand in their retained earnings. So we have a male age 50 earning 5% in a fixed income portfolio. And you and I both know that if we could get somebody 5%, you would not be on this talk today. You would be out selling bonds at 5%. So yes, we can also adjust it for the interest rate, but for the example's sake, I'm just using 5%. I'm also going to use a corporate tax rate, of 50%, right? So it keeps the numbers pretty even. So here we start out with a $3,075,000 balance. And if anybody, so my father was a financial advisor. Keeping a balance sheet was very important in our family from a very young age. I wasn't always so good at this. I've learned to appreciate it much more as I've gotten older, and fortunately our kids are really good with their balance sheets. But we've got an individual, if he started at $3,075,000 and he ended the year at $3,151,000, regardless of what's sandwiched and happened in the middle, we would all agree that this person won the balance sheet for that year. And if we looked it out over a lifetime, if they started with 3,075,000 and they ended with almost 7,003,000, we would say that this person won the balance sheet game. It would ignore everything that went on in between, but they would die feeling like, you know what, I'm passing on a lot to my heirs and I did well over my lifetime. And so if we take a look on 3,075,000 at 5%, that's 153,000 in interest earned on the year. And at 50% tax rate, that's going to be $76,000 in tax transferred away. Now, what you'll notice is that tax bill increases year over year, and the cumulative of that tax bill over that 35-year period is $4.2 million. So they worked hard. Remember, business owners work hard, just like you folks work really hard to bring clients to the table. These business owners are working really hard to save up that money and grow it. And at the end of the day, they're going to transfer a large portion of that away in tax. And if we could recoup that back into their financial life just by making a pivot, just by introducing a new asset class that they could transfer money into, would they be of interest in hearing more about that? Fortunately, in my career, they've been very interested in hearing about this. Just in case you couldn't follow it on the last page, but you like it in bar charts, $7.3 million at 85 and $4.2 million in tax. So let's see what that looks like. So obviously that's an increasing tax bill as we talked about. And what we want to talk to them about is levelizing that tax and recouping that wealth back into their financial life, right? And so how does this work? Well, it's a little bit of a step difference. And I'll tell you, there's a good friend of mine that lives in the city of Toronto. And a couple years ago, this guy made 8 figures selling insurance using this concept, this and another concept, but these 2 concepts primarily. And it was the idea, what they talked about, because he had a coach, several people on this call will be with that coach, but he had a coach that taught him the idea of putting money into another room. Now that other room, when you describe it, is just permanent life insurance. It's whole life insurance. It's all the attributes that we get with whole life insurance, right? But it's the idea of introducing this idea and putting the money into the other room without saying, you know, whole life insurance, because then all of a sudden people say, well, I remember when Uncle Jimmy bought whole life, that went bad. Maybe I shouldn't listen to this. I remember Dave Ramsey saying this. I remember Susie Orman said that. You know, what we want to do is get them to come through the idea and understand where their wealth is going and where their wealth is eroding, right? And what the opportunities are in between. So if we have to use the description, calling something the other room, and then describing all the attributes of par, and then lifting the veil off and showing par, I think that's a pretty good way of doing it. So here what we're doing is we're repositioning typically the fixed income, because this is the non-sexy stuff, right? If this is equities and real estate, this is where your client wants to play. This could be second mortgages. This could be other businesses, you know, but what we're looking for is this stuff, which is the really punitive stuff. And what we're going to do is the accountant's going to take enough to pay the tax, and then we're going to take the balance. And as opposed to reinvesting that back into the fixed income, we're going to move that into the other room, right? We're going to move that into the tax exempt life insurance and see what sort of synergies and what sort of wealth recapture we can actually get from this. And so we start out with our 50-year-old male, looking at over the same 35-year period. You'll notice though that the starting balance is 3 million, not 3,075,000, and that's because we know that life insurance is designed to be paid annually upfront. Now, if you look at this and you have a client that has, you know what they have in their balance sheet, you know what sort of interest they're earning, you know what sort of taxes they're paying, we can create a custom presentation that shows the first transfer over and then what can be transferred over on an annual basis thereafter, just like what we're seeing here. So here, what we've got is $3 million starting balance earning 5%. That produces 150,000 at a 50% tax rate, means that 75,000 is going to get it transferred away in tax, and 75,000 we're going to put into the other room. Now, because we've positioned that money in the other room, we end with a balance of 3 million bucks. Right now, this probably doesn't look too exciting, and it almost looks like it should be a non-slide until we go back to that middle blue out column here, which shows that the tax bill reduced by $1.6 million. So from $4.2 million to $2.6 million. So we transferred away $1.6 million less in tax by using the other room strategy. But if all we did was compare what's in front of us, this is not even a push. This does not look exciting to me. We started with 3 million, we end with 3 million. But this is only if we don't take a look at the action that's going on in the other room. So let's take a look at that. So we transfer 75 grand into the other room. Right off of that, we do see a drop. So we are below water. Remember, one of my early mentors said, when do we get above, like how deep is the water? Well, in the first year, it's below water, right? But if they pass away, we're going to end up with a massive death benefit, a couple 1,000% return, and a lot of CDA credit there. So that's what we're trading off for us being below water in our cash value early on. But we're not seeing the drop in book asset from moving cash to cash value that we would in an estate product or in a non-overfunded insurance product. So here we're max funding this contract. This product, once again, by the way, the water was 3 feet deep for our 50-year-old male here. So in year 3, 75 grand of growth or greater. And the product went from the red to the black in year 5. And so it fit really well. Don, you have something to add, I see.
Well, I'm only jumping in for sake of the people who are either LEAP, Circle of Wealth, or Truth Concepts people. They'll be familiar with I love what you've done so far. So the other point to make to the other people who aren't familiar with those concepts is there's not only a loss of the tax. If you go back one slide for a second, if I could ask you to do that, if you can back up one. The $75,000 tax column, there you go. So remember that if the $75,000 goes to Revenue Canada, there's also a lost opportunity cost on the $75,000. So I know when we initially talked about this a couple of years ago, the company wasn't comfortable with showing the lost opportunity cost of having paid the taxes as well. But if in my portfolio, I'm getting a 6% portfolio or a 5% rate in my portfolio, I've also not lost the $75,000 at 5% for the rest of my life. That's the first thing. So that's called lost opportunity cost on that decision. Go to your next slide. Someone's asked in the commentary, what dividend rate are you showing in those two illustrations? One where I'm knee deep at 3 years and I'm good in 5. It was the 219, 220 dividend rate. So it has dropped a little bit. What I want you to keep in mind, everybody, is that this is a concept. So that the tax is going to be a little negotiable. The dividend is going to be a little negotiable, -1, -2. But if you understand the concept, and if we had another column showing the lost opportunity cost of those decisions, we're way ahead. If we didn't pay the tax, if we didn't have to pay the tax, we've got to pay tax. But if we saved tax, we also saved the earnings on that tax that we would have saved. So that column doesn't show up anywhere in this presentation. That is a column that's available in either Circle of Wealth or LEAP or Truth Concepts. We talk about that all the time. And that's the phrase, if you were losing money unknowingly and unnecessarily, when would you want to know that? That's an important phrase because everyone wants to know that. And this supports that decision. Go ahead, Brent.
Yeah, no worries. And let me just say so this is showing on current. But remember, I'm showing a 5% yield on fixed income. So if we're getting 5% yield on fixed income, by the way, your mortgage is not sitting at 3 points anymore, right? Because the bonds and lending work hand in hand together, and PAR will work with that too. So if we were going to do this in today's environment, we might show this at a 2% yield on investment, and we might be showing that as to what that looks like against a -1. So like as Don said, this is conceptual and by nature. We can play with whatever it is that you feel comfortable. I was at KLU last week. We did see an economist there. I happened to watch an economist the week prior. And I will say that there is a strong inclination to inflation coming back and interest rates going up. And you can do the math. If you're holding negative debt, that's a really bad position to be in. But if you're holding a product like this that actually performs well under those scenarios, it's good for your PAR. It's bad for all those other things that you might be doing. So here, red to the black, total, we'll line this up in a second, but we've got the 3 million in the fixed income component. We've got the 4 million 8. We're not giving up our liquidity use and control of that money. So if I need to repatriate that back into my business, I've got a great business opportunity. I've got an investment opportunity that has come up. I have the ability to do that, right? Typically when we're doing this, yes, you can do this out of policy loans directly, but we've got to be cognizant of what the adjusted cost basis of the contract is and taxation on that. A lot of times, I'll be honest, we're just using third-party banks, and we'll do what's called we'll call this a deferred immediate finance. So it's not a back-end leverage like what an IRP would be, but what we're doing is we're bringing that money into our corporation via loans, and the death benefit will retire that, or we'll retire that when we sell the underlying asset. So lots of options, choices, and flexibility, and that's really what we're trying to push into the client's life, along with some tax deferral along the way. And ultimately, remember, nobody gets out of this life alive. So we've got the $3 million in the bonds, plus we've got the death benefit over here. And so let's just line these things up and see what the end result looks like. So by putting this twist or strategy in play right off the bat, we're going to save 38% in tax transfer. That's 38% less of our wealth that we've transferred away to our friends in Ottawa. And as I said, you have to pay your fair share, but you don't have to leave them a big tip. And so by reallocating it into the life insurance, let's say this person dies at age 85, the value of those investments are $7.3 million, and the value of the insurance and the $3 million portfolio is $9.6 million. So that's a 32% bump. But remember, this is only at the corporate level right now, right? So this is only into the corporation. We still got to get this stuff out of the corporation and into your heirs' hands. And that's where we're going to see why life insurance people are so cool. That's where we're going to see this tax wizardry in motion. But I do want to point out that, remember, there's $3 million in cash position here, and there's a 4.8 million position here. And so if I need to access that money, if I need to leverage on it, I can. And if I never need to do that, well, then I end up in this scenario, right? I end up with 7.3 coming into the corporate, that's sitting there on the corporate balance sheet, or 9.6 million on the corporate balance sheet. That's what's going to be there for those heirs. But once again, we got to get that out of the corporation. And so if we pay that fixed income account out of the corporation, we're going to do that with a dividend. So it's going to be a grossed up dividend, because we're going to take into account the refundable dividend tax on hand account. And we're going to end up netting down to $5.4 million. And in the other side, we're going to have a combination of refundable dividend account, plus we're going to have the life insurance with the capital dividend account amount. And so we're going to end up with a total amount of 8.5 versus 5.4, or 57% more going to the heirs. Now, you may say, I've had several wealthy individuals say, I don't really care if my kids get 3 million more, like 5 million is more than enough. And I don't want them to be, I want them to have enough to be comfortable, but not enough that they're unmotivated in life. Well, if that's the case, maybe your client has been very philanthropic throughout their life, and they would like to make sure that the charities that they feel are near and dear to their heart get taken care of. And so we can then twist this into an idea of recapturing that lost opportunity cost in tax to put more philanthropy and good into the world. There's a bunch of different ways to spin this. The other way too is, if you were fine with them getting 5.4, then that leaves you with about 3.1 that you can spend in your lifetime. So, we can pass on as great to the heirs, right? While still being able to enjoy a large portion of that money, which effectively, just this one pivot effectively increases the net rate of return to his overall portfolio by recapturing that tax. So it's a really awesome it's a really awesome strategy from that point. Is we're not asking them to take on a bunch of risk. We're not asking them to not pay tax, but we are asking them to rethink how they're doing it to achieve more for themselves. And we want to help people plan like the Rothschilds and the Rockefellers versus the Vanderbilts, right? We want to make sure that they have options and choices, and that businesses don't go shirt sleeves to shirt sleeves in 3 generations. And there's only really one thing that's going to do that, and that's proper planning and money. So what do we get out of this? Well, we're going to levelize and recapture that tax, pulling that wealth back into our family. And we see that immediate bump with the life insurance. So we see that immediate increase in estate value from the life insurance. We're able to accumulate wealth more efficiently, more tax efficiently, right? Because we know that as we grow money in this, we're not being taxed on an annual basis. And when we pass away, that becomes tax paid up or tax free in the corporation, and we get those CDA credits. But in addition to that, and not included in this presentation, but it is a bonus add-on. I feel kind of like Ron Popeil on an infomercial, but if you have clients that are getting close to that $50,000 passive income threshold, life insurance does not add to the passive income amounts on an annual basis. So we don't have to worry about small business grind down. This becomes a very efficient tax tool. And remember, if you just go back to when that small business grind down came, I remember Jamie Gollenbeck and Tim Sesnick wrote a lot of articles saying one of the things you want to consider corporately is the use of corporate-owned life insurance. So that way you're not getting ground down and paying more taxes that you need to. Folks, use these articles. These folks are helping us in positioning life insurance, and they are thinking outside the Susie Orman and Dave Ramsey box. The last thing we get is we get that greater distribution. So we seen that was a 54% bump up, and that's because we're combining not only the RDTOH from the fixed income component, but we're also including the life insurance death benefits in that CDA availability. And folks, that's really probably the biggest ace in our hole, the biggest arrow in our quiver, is the fact that we have the ability to do something that no other professional does, which is with a stroke of a pen and some ink on some paper, we create a massive liquid estate. And that estate, when put inside of a corporation, only the life insurance professional gets the ability to say they can create immediate capital dividend credits. It's a really awesome tool, and we should be thankful every day that still exists. If you like this piece, first you can just go to your regional sales manager and get it. But you can also go on Equinet and find this piece. It has all the numbers that you just seen in there. Yes, this will be updated because we just did our most recent dividend scale announcement. But it has all these numbers, and it's kind of an easy to follow thing. You could do this exact presentation out of there. We structured it this way because then that way it becomes like a conversation piece or a tent pole for you. The next thing I just want to hit you on, and then we'll open up for any questions. So we've got a guy that does what I do, only out of Quebec, and he's a brilliant math guy, and he put together this portfolio enhancement strategy, and I love it. I use it a lot with clients, and I just want to show you a case that we went through, and I just thought it worked really, really well, and it resulted in a great sale for the advisor. So here we had a male 53, non-smoker, the successful manufacturing firm that he's owned for the last 8 years. Believe it or not, this guy's already had an offer to sell. Like, that's pretty awesome, but he's still really young, doesn't have the desire to sell it. But he does, we had a really cool conversation. And I remember asking him, I said, is this business built to sell or is this business built to last? And he goes, I never really thought of that. And he said, well, I can tell you that I have like young kids and they're not really interested in this business. So I bet you it's built for selling, but I'm not interested in selling right now. And I said, well, great. Well, what do you think that timeline would be? And he goes, well, probably not for about 15 years. So somewhere between 10 and 15 years. I said, great. So, we've got a good stretch of time with this individual. He's earning good money, retaining good money in the company. They did a reorg to introduce a family trust and whatnot, a holding company a couple of years back because they could see the growth of the company. And so everything was lining up really, really well with this individual. The interesting thing was all of the investments were in cash, right? So like they literally had bank accounts on bank accounts and there was good money, but that's all they had, right? And the funny thing was that so he had some GICs in there too. But when we asked him what he's earning, he says, I don't know, like 3%. I was thinking, there's no way this guy's earning 3%, but okay, we'll use your number. And so that's what we ended up going through. He has term insurance that he owned personally. We discussed the idea of what participating life insurance could offer him as a unique asset class. And some of you will be used to seeing these sorts of slides, but first thing we did was we showed him why paying for it corporately in his holding company would make sense, because it was a much cheaper corporate tax dollar to pay that premium on. That wasn't too hard to get his interest on. It wasn't in the 53. This is just the slide we're using, but he was still in a much higher tax rate than what he was paying corporately. So that was a pretty easy sale. At the same time, too, some of his insurance remained in personal name, and that's because they needed that liquidity out there. We wanted to make sure that if anything happened to him, we didn't have all the liquidity tied up in his company. So that way, his wife wouldn't feel anxious if anything happened. We have a couple different versions of this particular slide, but what we did was we went through all the things that they could own corporately, right? All the different type of asset classes. It was done in the holding company, but sometimes you're going to meet with clients and they've got this money in their opco. And if their business isn't saleable, that doesn't scare me so much, except for the non-creditor protection. And a lot of times when we're dealing with doctors, dentists, depending on what province they're in, they may not be able to have a holding company. So planning with inside that professional corp can make a ton of sense. So what we did was we went through, for him, we only had to go through this asset, right? Fixed income, because that's where all his money was. We talked about growth being low, risk being low, that he was taking all his risk in his business. The way he looked at it was he was like Tom Brady. He was running the offense and throwing touchdowns, and his fixed income was really like his defense, right? And what we wanted to show him was a better defense to have on the field. So that worked. This guy was a sports guy, so these analogies work really well when it's a sports individual. From a tax treatment standpoint, we know it's ugly. He earns $1, he's paying 51.7 away in tax, so really ugly that way. From a distribution standpoint, if he needs to bring that back in his company, he could just cash out whatever he has, true. Or he could leverage on it if it's sitting in bonds, and bonds will leverage at around 75 cents on the dollar. And from a distribution standpoint, when he passes away, there'll be some dividend tax to pay, but it'll be grossed up with RDTOH. So we went through all of that. Fortunately, we didn't have to cover off equities, real estate, second mortgages, any of that sort of stuff that they may have been invested in. But what I'm saying to you is you want to do this. The more you understand what your people are holding and their role in deploying those assets, the more you're going to be able to thoughtfully see what it is they're going to like about your offer, and how they'll be sold, right? Like how they'll want to buy that insurance without breaking their value system. Because there's nothing worse than you going and saying that permanent life insurance is the answer, and they're thinking, maybe I'll just buy another building and Junior can sell that and pay the tax. The problem is they're not looking at how that perpetuates the problem and doesn't solve the problem. And what we're doing when we sell people permanent life insurance is we've got growth somewhere more between the fixed income and equity over the long term. The risk is more like the fixed income. The tax treatment is great, as we went through in the last part of the presentation. There's a lot of tax efficiencies that we get. The distribution out through the capital dividend account is top notch, A1, can't be matched. And from a access standpoint, life insurance is a really cool asset. Like equities, some banks don't really like to lend off of equities, right? And if they're going to lend 50 cents on the dollar. On fixed income, you're probably looking somewhere between anywhere from 70 to 80 cents on the dollar. But life insurance is an interesting asset because banks are willing to lend anywhere from 90 to 100 cents on the dollar, depending on the banks, right? Against the cash value, right? And so it becomes a really cool and interesting product, especially if I can put my money into it. And then if I need it because my business is in trouble, or I need it because of opportunity, I can repatriate that cash back into my business. And if something happens to me, that loan gets retired, the family has the business, and they get the balance of the life insurance. It is a perfect asset for wrapping things up and providing security to these folks. And so what we want to do is usually we're moving this fixed income stuff because this is the stuff that's not sexy to them, right? It's this stuff. And I don't see a lot of equities. Like when I'm dealing with doctors, dentists, lawyers, yeah, I see a lot of equities. But when I'm dealing with manufacturers, car dealers, real estate developers, real estate entrepreneurs, I don't see a lot of equities in their portfolio. And we'll use different strategies with those folks. But here we're moving fixed income to life insurance to try and create greater efficiencies, just like what we talked about in the last part of the presentation. And what we're going to show them here, so, and by the way, if this looks a little blurry, it's meant to. I didn't go have head office create some slides. I wanted to show you what gets produced in this particular concept that was created by Carlo, our advanced case guy in Quebec. So it's called the portfolio enhancement strategy. And here what we have is our client, right? 43-year-old male. Down here, I'm going to skip this middle section and come back to it, folks, right? So here, what I've got is this guy's got $706,536 sitting in his account. He did not know his RDTOH balance. And at this point, we haven't elevated up to the accountant to find out if there's any RDTOH or CDA balance. I suspect there will be some RDTOH balance here. But this is what we're rolling with because this is the info he could give us. He's been retaining on average 82 grand a year. How I got to the average was we actually took a rolling average with this individual of the last 3 years, and he felt that that was only going to continue to increase as new product and division was launched shortly. But we worked with the numbers that were on hand, $700,000 plus the 82 that he's going to start retaining. What we're saying is, this guy said he might sell his business in 15 years, but it could be as low as 10. So I want to make sure whatever we do wraps up nice, neat, and in a bow in 10 years, right? So what I'm doing is I'm reallocating, and in this case, I know it, I chose to reallocate 33%, 1/3 of the assets into permanent life insurance, leaving 66% for him to maybe go and do something more exciting with his money, right? And so that results in $50,000 a year of deposit. So if you take all of those numbers and you factor it out to 33%, that'll work out to $50,000 or 500 grand over that 10-year period. 50 grand a year, max funded wealth contract buys a face amount of 858. We're right in that spot where my glasses are needed, but 858. And I'm running it on current, but I could have run this on current -1. I could have run this on current -2. Doesn't really matter to me. Whatever you feel comfortable with, remember, it's a concept. We'll make it work with you. So this thing starts to produce a bunch of numbers. Oh yeah, this is the one that I sent to Don. So it produces all the back and forth for the numbers. I want to skip down. I actually, on the one I was going to show you today, I moved this up to page number 2. So this is like the last page in the actual summary. I'll go back on those numbers in one quick sec. But what we got here is, if you did nothing, if we just walked away today and all you did was continue earning money at 3% from now until age 85, you'd have deposited $1.5 million. That would have grown to be $2.1 million. I'm assuming that on this platform, this gets a little more blurry because that's usually a little clearer. But take my word, that's $1.5 million, and that's $2.1 million at the end. And that's because we've paid our taxes all the way along, and then our family has to pay additional taxes to get this out of the corporation. And so, the 1.5 that we built up, that we put into it, physically deposited, is only going to be worth 2.1 to the heirs. If all we did was reposition 1/3 of the portfolio, right, to permanent life insurance. So you'll see that's 500 grand down here in the life insurance that we've deposited. It's $1 million up here in the regular portfolio. We end up with a total of $4 million, not 2.159. We end up with $4 million. Now remember, somewhere along the way, this guy's retiring, right? So he's going to want some of this money. So the nice thing about this is we're able to say to him, see this 1.4, you can spend this in your lifetime because there's still going to be $2 million here. And oh, by the way, if you say that I don't really care to leave my kids $2 million, then we can start spending down this, and that will backfill and leave the estate for the kids, and it'll come out through the capital dividend account, right? At that point, we could also leverage on the house. There's just so many options of what we can do. So here, remember, 33%, this isn't an offensive number. This is an asset class within a total portfolio. I didn't ask for it all. I didn't ask for half. I asked for making a 33% pivot in what you're holding. We don't give up our liquidity, use, and control of that money, right? So I'm still going to have very high values, and I'm getting more because I'm not transferring away that wealth in the form of tax, right? So I'm gaining greater efficiencies with my portfolio. All of these pages, and I'm going backwards in the presentation, is all of the back work that you're going to need to show the accountants, to show them how it works, and to account for all the, the RDTOH and the CDA credits and all of that stuff. So all of this is included in here. And I don't particularly like line charts, but this will show you why it makes sense and it's efficient. Ultimately, and by the way, this is on the bottom. So this is the top of the page, and this is actually on the bottom of the page. And if you couldn't even follow the easy pie charts above, all you have to do is see this and realize that by making this maneuver, I don't give up my liquidity use and control of that money. And my estate ends up 88% better off having made this one maneuver, right? And so it becomes a very great conversational way to go out and see a client and say, here's why you might want to consider permanent life insurance. And done these things in a -1 scenario, we still end up better off, folks. Maybe we don't end up with as much juice, but we do end up better off than where they are. And ultimately, I like to find out where the clients think that fixed income is going to go. And then from there, we plan on that. So once again, I want to thank you, Equitable Life, 100 years old. We do thank you for your business. We know that it's not guaranteed to us. We do try and earn it every day. We are a mutual company, and we think that really sets us apart. And if you haven't seen any of the new videos up on YouTube, I urge you to go take a look at them. We've got one with Kara Mason explaining why mutual is important, and one with Sheila Hart talking about our profitability and why that's great for Canadians that choose to do business with us.
Brent, fantastic. I'm going to go through a couple of questions that we have in the that we got through the chat.
Sure.
The one question is you mentioned Jamie Gollenbeck and Tim Sesnick. I just wanted to reiterate that information, and I sent the spelling of their names back out in the chat, that if you wanted to Google those names, there's lots of articles out there by Tim Sesnick on the value and power of life insurance. I think he's got the 10 reasons for life insurance that he had in the Globe Mail a couple of years ago. You can Google that and reference it. So that's there. The other thing that came up, Brent, was the brochure. Could you give us the brochure number on the brochure you showed in the flat levelizing the tax, or go back to that?
I could.
You can even go back to that brochure.
Yes. I don't know if it's actually in this presentation. Let me see.
And Brent, when are dividends guaranteed?
You mean like when we credit them to the contract?
There you go.
When do they vest?
I want everybody to hear that from your lips, because I say it all the time, but we always get that blowback. Well, dividends aren't guaranteed. Well, they are once they're paid. How often do you pay them, Brent?
Annually. And
Annually, every year for 100 years.
Well, not for 100 years, since 1937.
1936.
But there are some folks making that statement, and it's true that some places have paid a dividend. They just haven't paid it on all their series of contracts. And right. I know that certain firms, we have paid them, and Equitable is one of those, right? So I'm looking up your number there, just in case you're wondering what I'm doing.
Yeah, no problem.
If any of my colleagues are on here and you know that number, if you could throw that up, you're going to save me a.
Well, I guess Kelly Ganter didn't get an invite to the webinar, so she's not. Marie Dean asked this from Edmonton, so I'll say hi to Marie Dean for a second. And we'll make sure that we get this brochure to you, Marie. The other question that came up was the CDA. And I think I'll just ask you the question as it was asked.
Sure.
Estate or wealth, it doesn't really matter which policy, the crediting to the CDA is the same. Just the amounts would be different depending on if it's a wealth or an estate product, correct?
Yeah, so yeah, those products differ based on growth pattern. But remember, right. CDA is it's a calculation, right? Oh, there we go. Sebastian got that number. Beautiful. So CDA is a calculation, right? It's everything over and above the adjusted cost basis, and adjusted cost basis is premiums minus the net cost of pure insurance, right? And so, once that grinds to zero, and remember, personally, when we own a contract personally, we want that ACB to be as high as possible, as long as possible, because that allows us access to our cash, and we don't care about capital dividend account credits. But corporately, we want to grind the ACB to zero as fast as possible, which kind of screws us on the direct loan side of things. But is what gives us access to that capital dividend account. And remember, capital dividend account is a way to create tax fairness or integration implemented by the insurance company, right? Or not by the insurance company, sorry, by the CRA. So that way, if I own something in personal name versus corporate name, I'm not being penalized for that. But not, not the attorney, not the stockbroker, not the real estate agent, not the accountant. Nobody can impact the CDA the way we can, because once somebody puts life insurance in force, it works great if you live long, but it also works pretty darn optimal if you pay one monthly premium and drop dead the next day. Like, you'll get a lot of money out through the CDA. Won't be that attractive. It'll be a great rate of return on money, but we have a very special position with business owners as far as creating liquidity and being able to, basically kick a trap door into their business and get that money out to their families very efficiently.
I also want to give Mr. McNulty a plug. You should probably too. You've got an advanced estate planning person at Equitable Life that would help our advisors in any situations that you might have. And I want to remind everybody that we have Frank Abate, Brad Hyde in the West, Frank Abate, Ontario, and Chris Britton for the East, to refer to any kinds of situations where you have an owner of a company. We had a tax planning, advanced estate planning session on Monday. So some of these things came up in a conceptual way, but not as much detail as what you've illustrated today. So we will send out the PDF of this presentation to all attendees. We have also recorded it so you can hear how Brent delivered it. Some of the terminology you'll recognize if you're, again, a LEAP or Money Tracks or Truth Concepts or Infinite Banking person. Lost opportunity cost, LUC, we call it luck. But liquidity, use, and control of your money is very important to business owners. They still have access to those assets. And Brent, I just want to say it's a fantastic presentation. I really appreciate it. I know the audience did as well. I look forward to seeing you again in a more in-depth session on the CDA. Maybe we'll do something special on the CDA.
Sounds good. Sounds good. I'm looking forward to seeing you live and in person.
Yeah, no kidding. We got to get across Canada, do some webinars or some seminars, I guess. I'm so used to saying webinars now. That's all I say.
Yeah, no, for sure. And by the way, Brian handles the East. We've got a very amazing resource out West, a guy by the name of Marvin Toy. My counterpart out West is Chris Thompson. So if anybody remembers Chris, he was with me at the last company too. And he's an awesome resource, just a great center of knowledge. And I don't think there's anybody in Quebec here, but if there is, we've got a guy called Carlo Di Girolamo. He was also with us at the last company. Carlo is just a great resource as well. And most of you will know your regional sales managers. They're phenomenal too. And we're on their team to help level up a scenario if it makes sense.
And we do have Carlo on this is in Quebec right now in English. We had Carlo this morning at 10 o'clock doing the French version of this presentation to our French-speaking constituents in Quebec. So
awesome.
Again, great job by Equitable Life. Really appreciate this flyer that you've produced. It really supports the concepts that we expose to our advisors. So it's fantastic, easy to use, easy to read. It's a nice pre-approach piece. If you've got a business owner you want to go see, I would send this in advance, do a webinar like this. The slides, you can use the PDF in terms of explaining some of the concepts. You take out some of the slides, adjust it how you want. If you need help with any of that, contact your local business development executive at IDC Worldsource. Contact me. We'll get the information you need to get done what you need to get done. So Brent, again, thanks for finishing off the week. Fantastic presentation to finish the week off with. And we look forward to seeing everybody next week at our university series starting on Monday. Have a great day.
Thanks, Don. Thanks, everybody.